As usual, I'm Alex Varner, our head of research, alongside
James Maxwell, VP of research.
Let's get into it. This is a pretty heavy data week for the employment sector in particular. On the performance, just a brief touching on it, the bottom two charts, as usual, are the trailing week, more red than blue or green or however you want to call it. For the sectors, communication services led the way, while energy was a big laggard, down 3. And then on the kind of broad market indexes, emerging markets and small caps led the way. And we've seen a bit of a rotation into small caps here of late, which I think people are viewing as a kind of good thing as you get a broadening of the market.
Yeah, some of the broadening, some into the cyclicals. I know small caps very, very sensitive to the broader economy. So that's been a talking point, is how those have been trading, especially since, kind of over the past month. And especially with regards to the employment report, which we'll jump into.
Yeah, and also just for noting now, all 11 sectors are positive on the year. Healthcare is up 0.2%, but it had been negative basically until now. So finally poking its head back above water. On the recession dashboard, not a ton changed here. Kind of, more blues, a couple of greens. We think the PMIs and retail sales are maybe going to start tailing up, but for the most part, things are kind of sideways. Flattish, up a little bit, down a little bit. On the data side, the big piece this week was really the non-farm payrolls report. That came in well below forecasts. It was up just 22,000, below forecast for 75 or 80,000. June and July were revised down by 21,000 together. And notably, that June figure is now negative. It was revised to a negative 13K. That's the first decline in payroll since December of 2020. The 6 months average is at its lowest level since September of 2020. I think one thing that's a key to remember here is on the immigration side of things, where you have a far lower level of immigration, the break even is kind of uncertain. 22K is it's not great, but if you've gone from 80 or 100 or 150K on break even to 30 or 40K, it's far, I guess, easier bar. And so this 22K in that perspective, maybe it doesn't look quite as bad, but it's still pretty soft.
That's one of the things that I've been looking at, is that break-even rate, because you have a decline in the supply of labor from lack of immigration or even deportation, and then also
and boomers retiring
and they're retiring, and you have a decline in what looks like demand. It's kind of very hard to see exactly where that break-even level is, which makes things even more complicated.
Yeah. So, again, headline kind of soft. The wages were up 0.27% month over month, which was in line. They're up 3.7 year over year, which is the smallest kind of year over year increase since July of 24. But that's still above pre-COVID levels, which were like 3.4, 3.5, 3.6. So incomes are still continuing. You can see here, even in this chart, they're still moderating. They're still in kind of a slow, decelerating downtrend on the year over year. Those COVID distortions were really, something else, especially on the wages side and government transfers as well. But I guess, kind of the takeaway is the FOMC, this kind of increased the probability. I think at one point, the Fed Watch tool was showing 100% odds of at least a 25 basis point cut. That's back to like 90 for 25 and 10 for 50. But anyways, markets are clearly signaling that they think the Fed should and will
at least a cut.
Cut 25 basis points. Yeah. I think I saw something this morning saying that the dissension, if there's a dissension, it will now be for 50 versus 25 as opposed to 0 versus 25. So I think, we're looking down a cut and we'll see it September 17th. So it's another, next week here already. A little bit more in the non-farm payrolls report. The participation rates ticked up, which is a good thing. The 25 to 50-year-old 54-year-old prime working age cohort jumped to 83.7. That's the highest since September 24. So that's a solid increase. And then the overall participation rate ticked up to 62.3. But then again, so did both the unemployment rates. The U3 and the broader U6 rate rose. U3 is now at 4.3. That's the headline rate. And U6 is at 8.1. They're both the highest since October of 21. Another thing to keep in mind on the participation rate is it's good to see those go up, obviously, but this is again kind of where the math participation, you have to be actively participating in the labor force. So people who leave the labor force are taken out of this equation, and so that can sometimes distort the numerator and or the denominator and result in kind of the percentage moving higher. But it's higher is better. It's the easy way to look at it. We got JOLTS earlier in the week. These are basically a month behind payrolls, but they again kind of showed ongoing moderation in the labor market. openings ticked lower, hires and quits were basically unchanged, and layoffs rose to 1.8, which is the highest in September of 24. But again, kind of when you take this in conjunction with the relatively weak non-farm payrolls figures, it's like the Fed is room to cut from the employment side of things.
Yeah, it seems like basically every labor market indicator is saying that we're at least at a stable environment, if not weakening.
Mm-hmm.
Very little kind of strength shown from many of the indicators. So all the Fed is basically looking at now, at least in my eyes, is the inflation side of things, which we'll be getting this week.
Yeah,
with the CPI and PPI.
Exactly.
But yeah, sets them up for a cut, if not a larger one.
Yeah. And then, something within the JOLTS here, the last month or two inside of this report, the delta between hires and separations went negative for the first time since December of 2020. So basically 74,000 more people either quit or got fired than were hired. That's the first time, again, in like 4.5 years here. It went back positive in July, but clearly the market has been softening. Again, no surprise there. And then also in July's report, we had the ratio and the number of openings versus the number of unemployed persons, and that dropped below 1 for the first time since April of 2021. So historically, that delta has been negative. You can see on the right side there, the green bar is overwhelmingly below 0, and you really had a change in that dynamic coming out of COVID. So now you're kind of looking at a normalization, I guess.
Yeah, I mean, you can see how high those openings got relative to the unemployed in like that 2021, 2022 peak. I think there was a lot of kind of wood to chop through there, getting back that normalization of the labor market. There's a lot to be said on like the openings and if there was overhiring and kind of what is going on now. Is that a result of overhiring? Is it a result of actual like economic weakness? It's not exactly clear in my mind. I think the broader takeaway is like normalization and a kind of cooling of the labor market where there's not a lot of hiring and there's not a lot of firing. It's just kind of stabilization,
kind of steady. Companies have hopefully had some success filling those openings that they had. And now they realize what a difficult time they had filling them, so they don't want to get rid of anybody.
So if you have a job, you're fine, but if you're recently laid off, it's much harder to find that another job.
And then staying on the employment side of things, we also got ADP payrolls. These are kind of the private sector payrolls. They added 54,000 jobs below forecast for a 65K figure. July was revised up, is a good thing, but it's that 6-month average there is its lowest level since October of 2020. Again, similar to the non-farm payrolls. The gain was driven mostly by medium-sized firms, which added 25K. Large were up 18, and small firms are at 12. Good to see that small firm reading start to tick back up. 12 is the highest in 4 months here. And that's, a good thing because they make up, as we'll show here on the right, they make up over 40% of payrolls. However, they are at their lowest share ever at 43.52 versus if you go 2 decimals, they tick below. But basically, medium firms and small firms are shrinking and large firms are starting to take that market share. Small firms are up to 18.4%, which is their highest share of ADP.
It looks like
ever.
That's been kind of a long-term, slowly grinding trend downwards of that small share on that blue line on the top.
Yeah, exactly. And then on the left, we show the year-over-year figure, and I think they're all in the green. But small firms are up 0.4. Total is up 1.08. Medium firms are up 1.1, and large firms are up the most at 2.4. So again, you're kind of seeing a shift in hiring towards those large firms. Or a shift in payrolls, I guess, as they perhaps their growth is outpacing the smaller firms. On the job cuts, this is Challenger, Gray, and Christmas. And again, these are job cut announcements. So these don't necessarily come to fruition. But when a company puts out a press release and says, hey, we're going to cut 100,000 jobs, this gets picked up in that figure. Whether they don't follow through with whether or not the companies actually go ahead and fire those people or what fraction it of. But the announcements are certainly an indicator here. And the cuts accelerated to nearly 86,000 from 62,000 in July. Hires are probably more notable here in that they fell to under 1,500 hiring announcements, which is the lowest monthly total that we have on record for this data. Year to date, we've seen nearly 900,000 cuts announced. And again, that's year to date, only 8 months into the year. And that year-to-date figure eclipses 14 of the last 15 full-year totals. except for 2020. And again, looking at numbers on an absolute basis in this way, when you have a growing population,
Yeah.
does kind of the numbers get bigger naturally just because you have more people. But it is, that's still kind of notable. And I think the bigger thing here is the delta of hires versus cuts, where cuts are just anemic. Hires are at 87,000. And we have yet to have a full year where cuts have outpaced hires. So hires have always been more than cuts. Seasonally, September is the strongest month as you kind of come into the holiday hiring. So we'll see if September, this next reading, picks up in hires, but they have some wood to chop to catch back up to these cuts. As far as kind of where the cuts are occurring on an industry basis, there are only 4 industries that have announced more hires than cuts year to date: entertainment and leisure, insurance, aerospace and defense, and fintech. Government is the big laggard. If you remember, those Doge cuts earlier in the year were a vast majority of that. But speaking of Doge on the right, you can see that the cuts by reason, Doge actions and Doge downstream account for like 200 or over 300,000 cuts. And then market conditions are roughly 200,000. So I think, you're seeing these reasons. Clearly, the government was to blame for a big chunk of this. And that's definitely kind of skewed where the overall levels kind of sit. But again, they wanted to make some cuts.
Yeah.
We also got Q2 productivity. This is a solid upward revision to 3.3 from the preliminary 2.4. It's the strongest reading since Q4 of 2023. On the right, you can see the components there, where output was revised up to 4.4, hours worked and employment revised down a bit, and then hourly comp was revised up. But basically, it's output per hours worked, so you can get output revised up and hours worked revised down. Overall productivity goes higher. On the right here, manufacturing productivity to touch on for just a second, is posted now 2 pretty solid quarters, and I think that's like 4 or 5 in a row of positive quarter over quarter annualized productivity growth. So that's a good thing on the manufacturing sector. You'd seen some weakness there for a while. That 6-month, the 20-quarter rolling average is its highest level since Q3 of 2014. So 11 years going back on that productivity, on the longer term trend on the manufacturing productivity. And then we got unit labor costs as well. Those are revised down to 1 from 1.6. That's a big deceleration from Q1's nearly 7% increase. So kind of, again, we have lived through this. It's Q2, but to see those kind of inflationary pressures trending lower is a good thing on that side. We finally, I don't know, we'll get there eventually. But the trade balance, that's been closely watched given all of the tariffs, trade war, whatever you want to call it. But the deficit widened kind of unexpectedly to 78.3 billion in July. June was revised from 59 to 60. But the change in July was really driven by a 5.9% month-over-month jump in imports on the right there. That's the biggest monthly jump since January, and it was reflecting a sharp increase in imports of non-monetary gold, which jumped 10 billion. The non-monetary gold is kind of funny. It's these, yes, as it says, non-monetary gold. You're not spending it, but that's resulted, or it's been the culprit behind a couple of the bigger skews in the readings as investors have moved gold into and out of the country.
Yeah, I've seen that before.
So it's just it's kind of a funny dynamic there, where it's not like these are people buying cars or computers or that sort of thing. It's been non-monetary gold, which is kind of a weird
technicality.
Yeah, exactly. Because technically it's a goods import, but if it just sits in a vault and doesn't really get spent.
Not exactly the same as importing a car.
Yeah, exactly. And also apparently, I don't know, is it subject to tariffs? I don't think. Wait, that might change tomorrow.
Yeah.
Again. And then exports are basically unchanged from June, up just 0.3% month over month. But if you look at the goods trade, goods and services, goods are by and large the dominant driver of overall imports. Goods imports are now back positive, up 1.5 year over year to 83 billion. Goods exports slowed to 2.7, but they were basically unchanged at 180 billion. Services, while smaller, has continued to grind higher, with both imports and exports are being at now rising to new all-time highs on a dollar basis. Services imports are up 6.7, and services exports slowed to 4.8. But again, those have been consistently positive as kind of the services trade has continued to move higher, while the goods is kind of, you can see there, it got clear front running on the tariff side and is kind of flattened back out and is back in that kind of trend line going back several years here. So, kind of in summary, non-farm payrolls in light at 22K with downward revisions to June and July. You got a good tick up in the participation rate, but also a increase in the unemployment rate. But we think this kind of solidifies the case for Fed to cut. That's kind of the big takeaway.
Mhm.
JOLTS and ADP, also kind of ongoing labor softening, moderation, whatever you want to call it. I don't think we're in an outright weakening. Like companies aren't cutting jobs. But as James mentioned earlier, it's just kind of this treading water
Yeah.
here. Challenger job cut announcements rebounded. Hires continue to just kind of languish there. Productivity saw a good upward revision to 3.3 as output improved. Trade balance unexpectedly widened as non-monetary gold imports jumped $10 billion. So that's kind of on the trade side. And then this month, as we mentioned, you get the other side of the Fed's mandate. Last week was really the employment
Mhm.
side. Now we get the inflation where you have PPI and CPI. And while, the Fed kind of states core PCE is its preferred inflation measure, once you have the PPI and CPI, you really have the
Yeah.
kind of a very good idea of what that PCE reading will be.
Mhm.
So it's not like you have to wait until the end
Yeah.
of the month.
Also, it's ahead of the Fed's meeting next
On the
week,
17th,
on the
yeah.
17th, on Wednesday, they'll be having their, press conference and announcement. These are the big pieces to watch that I think will have any influence over that
Yep.
rate cut. If they come in, harder than expected, maybe there'll be some doubts, or maybe it'll just be that only limited to the 25 basis point. But if they come in much lower than expected, you could even see that 50 basis point cut,
That
the
probability will
probability
definitely
increasing.
rise
Yeah.
for that, yeah. And then also finally, we get kind of University of Michigan Consumer Sentiment Friday. We talked on this, this seems a little broken. We'll see what it
Yeah.
comes out with. We do keep an eye on it because it is a long running, sentiment survey. But we'll see if that kind of continues to remain in the doldrums
Yeah.
here. And I think that's about it for the week.
Yeah.
So enjoy. Hope you had a great weekend, and we'll get back with you next week. Take
Thank
care.
you.